and then share my screen now. There we go. Okay, let's talk about market a little bit. Um, Obviously, interesting session on Friday. We lost 3-4%. Depends how you look at it. Um, and even more interesting because it doesn't, I mean, most of the time it happens, but sometimes it doesn't. You had a good relationship between VIX and the move down in stocks. So basically, you had roughly the relationship between 1 point down in S&P is usually plus 7-8% in the VIX. So I tend not to speak in percentage point in VIX, but that day that translated pretty well, and the output was something like 6 points up throughout the session. That's respectable. You don't see a lot of 6 points, especially starting from 15, right? Everything is regime based when it comes to volatility. So obviously 6 points when you are in a regime where VIX is already high, vol of vol is already really high. 6 points is nothing. But as we'll see in a second, Bolivar was pretty much non-existent these days. And you go from 15 to 21. You have to at least, even if you can have, and I was in front of the screen trading, so I was dubious when the move was happening, or at least a little bit. Don't want to use the word skeptical, but I was like, that's at least interesting, in a sense that it seems to be a bit overdone. But then you still have to do your due diligence, your math, and make sure that you're not running into a trap, because that's what you're really trying to do as a wholesaler. You're basically an insurance provider. A lot of people get caught off guard. They're rushing to edges, and you're wondering whether or not you want to sell to them those insurance contracts. So we went here really on the lower side of the curve, and anything that we've observed over the last 10 weeks. If you guys could put yourself on mute, that would be nice. Otherwise, I'll do it. Um, the Some of the lowest reading that we've seen over the last few weeks, and then all of a sudden you're here. So I thought I'd start by this one because even though everybody's going to be remembering what happened over the last few months and start to freak out and everything. At 21, you're already in the 80th percentile of everything we've seen since October 2025. So, first of all, it seems like it's not that high because 21, everybody will remember the 30, the 31 that we've seen at the height of the Iranian crisis. But if you put that aside, 21 start to be a pretty high price for VIX, at least in the current regime and current distribution that we've seen. It doesn't mean that it cannot go to 40, but at least it helps to set up the context. The second point is this one. So obviously last week we were talking about how VVIX was starting a new regime, so that's an interesting move because it's really going to be much sooner than I was expecting, confirmation or not. So you really have two sort of mode in VVIX, as we said last week. Either the mean is around, the average is around 100, or it's around 80, 85. And we're back right into 100, which is 50th percentile in VVIX. There's two way of reading that stuff. At least the way I'm reading that stuff is if the market was really getting crazy the way it used to be crazy up until now, I would have expected to see a VVIX move much more pronounced and potentially see 110, 115, which were readings that were not unusual. Obviously the last few months, but also last year, post Liberation Day. It wasn't too, it was quite often that you would see 115, 120. You didn't see anything like this, which again is one of those little small cues that tells you like, yeah, at the end of the day, 100 in VVIX was pretty normal. 21 in VIX is high in comparison to what we've seen recently. And the real question for me for VVIX is, are we sticking here or are we mean reverting towards what seems to be a more natural mean for the new regime we might be getting into? A note on this, I'm not particularly married to that idea that we're starting a new regime in VVIX. I think it's a strong possibility considering the set of prices we've seen last week. It's also possible that the market decide that, in fact, actually they're not ready to just completely dump VIX calls and VIX insurance overall, and then we go back to 100 and that stuff stays there. And ultimately, we're back to a regime where, yeah, you just have positive VRP. Things are expensive from an insurance premium perspective, and really, if you're a wholesaler, it's like it's great. I've written about this at length for almost a year now. If you've been selling option in SPY in the queues. More often than not, you probably made money out of it, especially if you were reasonable on sizing, especially if you were avoiding the zero DTs like 1 week or something like this, just to give some room for S&P to do its stuff. But overall, that realized volatility is always much further, much below than what you see in the implied. And with the move that we've seen on Friday, that's still pretty much very true, right? We basically went from um, 15 to about implied at 19, 20, something like this. And in the meantime, you have RV that moves from 10 to 10.35. So I often have to say this in the Discord. RV doesn't move this quickly, as quickly as implied, for obvious reasons, because it looks at the past, right? It takes the realized volatility, the daily realized volatility of the last 30 days, or really 21 trading days, aggregate all of that together, and then gives you a number. So obviously it's not because you've had a fairly busy Friday that all of a sudden your number is going to go crazy high. And therefore also that means that current RV can be misleading in the sense that it looks at the past and you're trying to know what's going to happen over the next 30 days. But what really academics and even market experience tells you is the best prediction of what RV is going to be over the next 30 days is very often, or at least a very strong approximate. So you can do better than that approximate, but a very strong approximate is RV today. So RV of the last 30 days is a very good proxy of what's going to happen over the next 30 days. Doesn't mean you shouldn't try to predict it or try to like get a feel for it, but as I said, right, because it's looking back the last 30 days, um, the type of move that you've seen on Friday is kind of indicative already of what's going to happen over the next few days. So it's not often that I'm showing this chart. So this chart is the classic historical volatility, but instead of putting period 30 days, it's literally 1 day. So 1 day of realized volatility is literally taking the 5 minute log returns and square them over what happened on Friday, and then you get a number. Um, and this is another cue, right? Like obviously the move was spectacular, 3% down, 4% down on the Nasdaq. But then, I mean, especially if you were in front of the screens, like it didn't feel super shaky. And I think Greg said that at some point that it felt like the prices in implied was not necessarily following what the pricing in equities was showing. I think, as we said at the beginning of the session, actually it was pretty much in sync. But what he probably felt and tried to express is that, yeah, okay, things are falling down, but they're not falling down like crazy, right? In comparison, this is Liberation Day period, so needless to say that one day realized volatility was absolutely insane. And if you have to compare to even last month, yeah, like the on the lowest days of last month, you've had pretty much 19, right? You've had a few scary days in March, but that and by the way, we never really lost 3%. And this time we lost 3% and we did something like 19, which is, it's not like I can't remember what happened on that day. Oh yeah, it's the day before the Tuesday before the first ceasefire. Market was much more agitated. Okay. So it moved, but it didn't move like crazy. Just stock went down. Okay. And then again, you go back to how you compute these things, realize volatility, and you're like, okay, well, if on Friday all we did was 19, obviously you don't want to over anticipate. It's going to be very interesting to see what happened on Monday and then on Tuesday because you have CPI. But if you do a couple of like 19, 15 days, that's not enough to drive your realized volatility so much further than 11, 12, 13. And essentially it goes back to what I was saying in the newsletter and what I often say in Discord. What's going to be the catalyst for us to see realized volatility go from 20 in one day to potentially back to those numbers, 40s, I mean, definitely high 30s and 30s and above. Obviously, anything on the Iranian side that might be a bit scary is probably going to get us there, but it's going to have to be more scarier than all the back and forth that we've had regarding the the ceasefire at some point. Could it be inflation numbers? Potentially. I'm not going to comment on whether or not someone should trust those numbers and how those numbers are going to come. Once again, it's going to be interesting to see how they come. However, the sheer fact that I am and we are, I just feel that I don't feel that it's just me, but we are the marketplace in a position where you are kind of questioning the numbers that you're seeing. First of all, it's not particularly healthy. But second of all, it's already a piece of information. And yeah, like if numbers come at 4% and above, and the market is probably really going to be shaken by that. But otherwise, again, you try to read information the way you can. But if we were really scared of inflation on Friday, anticipating a number a couple of days after, and all we can do is 19 of realized volatility on the Friday, that doesn't seem to line up. Like I didn't want to go back to the days of actually I could while we're there. I don't know how many of you were trading when you had the the inflation talk in 2022. Those days were really scary, right? It first of all, I often say I didn't particularly enjoy that period, but yeah, like we've had 19. That period, 19 was just, it was your normal Tuesday and your calm Tuesday, right? Okay, some days it was calm, but most of the time it was just complete chaos out there. And I'm not suggesting it cannot become chaos pretty soon and pretty quickly. Once again, the next inflation number is going to be quite interesting to watch. But so far, yeah, it happens. Some days you lose 3%, and sometimes you even have good reason for it. I think Hugo was suggesting that Fund managers need cash. You have some big IPOs that are lining up. So why not? Why not taking money out of startups that you don't necessarily believe in because they've had their days in the sun, and now it's time to just get cash for SpaceX, Entropy, OpenAI, and all the new cool kids on the block. Sometimes it's just as simple as that. You just need the cash. Obviously, again, like you have to be, you have to do your due diligence. 6 points, it's not nothing. You want to pay attention to it, but then go back to the business model. If you don't trade volatility when you have this, I don't know when you trade it. Like 10 points in S&P, you do the usual. You go 1 month out, um, and then you'll be fine. So obviously, I know that some of you may have got caught into like some stuff in like let's say 3, 4 DTs, maybe 7. Not to say, because what I'm going to say right now, obviously, I know that people are going to say that, like, oh, yeah, start to sound like tasty or whatever. Absolutely not. That's not what I'm suggesting. But let's say you got caught into some weird move here. Don't wait for the market to come back. What I suggest is you can take your losses here because you have accumulated a lot of delta. So basically, if you keep that position, you basically hope for the market to come back up, which is not really a volatility trade anymore. When you put it, let's say early last week, it wasn't fully a volatility trade. It was almost a gamma trade when you trade 70Ts or whatever, but still volatility, still has some Vegas. Turns out that that Vega was cheap. Now you have accumulated a ton of delta in your book. You need to do something with it. So you you can sell edges. So you can sell futures. I wouldn't recommend that when you have this type of term structure. What you could do is you can repurpose your negative delta into short Vega, which is really nice and super pricey these days. But for that, you have to take the loss. So close anything that you may have here in the short dated that may be close on well on the 18 or the 12, right? And that's probably a bit bloody these days. And then if we still have VIX 21, and if we even see VIX 22, VIX 423 on the onset on Tuesday, on Monday, potentially Tuesday, yeah, my suggestion is go take those prices because sure, implied volatility can keep going up, but most likely it's going to revert. And in that case, you sell some super high implied here, and the minute it will go down, you're being paid by Vega. You're also being paid obviously by Theta, and you can probably I don't know how you've sized things, and I don't know how you are going to if you're going to recoup some of your losses. But all in all, don't. I mean, it's fine to keep some of the deltas, right? You could also get long S&Ps. You have. I don't know how anyone's book is settled, but being long stock overall is not a terrible value proposition. Just once again, it's a matter of sizing and how you allocate capital to the different positions. So if you feel like being a little bit long is good for you, then why not? But if you feel like you have way too many positive delta and you don't know what to do with it, and you're just hoping that the market comes back up, sure, you can hope, that's fine. But there's probably an easier trade than the 50-50 that is direction, right? The directional trade is always 50-50. You kind of never know. Obviously, when you're long stocks, it's because over time you're basically playing momentum. Over time, you know that stuff goes up, but you don't exactly know when that's gonna happen. You probably have a better value proposition by literally being short Vega here, um, and saying, um, yeah, like those options are going to melt over time, even if implied was not backing off, you would need, as we said earlier on, realize to keep going up quite a bit for those position and those options to be challenged and theta not to do his thing. Um, the only reason why, and I insist on this, so if you guys want to call that rolling, absolutely you can call that rolling. I'm not calling that defending a position. I think this makes no sense. The only reason why, again, I'm mentioning something like this right now is because you have this. We would have we will have a much flatter VRP term structure, and by flatter, I mean literally close to zero, with no interesting z-score. I would tell you like, you know what, it happens, takes the loss, and then forget about the trade. But in that case, it's like, okay, it happens. It's a variance game. You probably get caught into some short DT stuff. If you go back further in time, like you're probably going to be able to make money out of it. So I personally consider that being two different positions. I try to really stay away from the rolling strategies or defending strategies because it um it gets you as a trader married to a position, which I don't think is a healthy state at all to have. I think when you're out, you're out, and sometimes it happens. You make some prediction of where implied is supposed to go and what realize is going to do, and sometimes you're out, so you have to take things off. But in that case, I think it would be a really waste of meat on the bone to just sit here hoping for the underlying to come back up when really you don't know if it's gonna come back up. When you can come here and then sell vol again and um, and wait for time to pass, and then ultimately probably make even more money out of it. Um, Anything else I needed to talk about in this chart? So yeah, maybe a little bit of vol. So it's even more surprising what happened on Friday that vol is really low, and usually you don't see the 6 point move when vol is really low. But again, it happens, and volatility clusters. What that tells me is, again, I'm curious of what's gonna happen on Monday and Tuesday. If you see again some big moves in vol, then vol obviously mechanically is going to go up as well, um, which means that the pretty much no movement that we've seen for most of May, maybe we're going to see movement in the VIX again, right? Like when I say no movement, it's you compare this, right? We were pretty much glued to the 15 to 17 in VIX. So maybe now we'll start to see a little bit more movement in session. So it doesn't mean once again that you should go try to do some intraday movement on vol. It's just really this one is, I mean, volatility is a measure of risk at the end of the day. So this one is really telling you what's the likelihood to see a big move up or down in the VIX over the next few days or potentially in session. It's still not super high. Let's see what happens. I wouldn't be surprised to see us drifting back to 18 or something like this and then having happy days like we had about a year ago where, yeah, VIX is at 17, 18. Sometimes it just spikes, but then realize never comes and then you get paid that way. Um, the queues are on the front page right now in the topics because the probability is quite high at 30 days and also at 9 days. So you have a nice little recommendation, and that's pretty much in line with what we were saying. Try to target the July contract about 35 DTs out. You can even go to the monthly contract if you ask me, because honestly, the calendar is quite packed. I didn't talk much about the calendar, but you have CPI, then you have SpaceX, then you have FOMC, and then you have half a year expiration, which probably is going to get things shaky a little bit. So you have enough for me to justify why all of a sudden people woke up on Friday and was like, yeah, maybe we need to buy a few hedges just in case. Uh, but my conclusion is I don't think there is enough for people to justify keep buying those hedges and also for Realize to cut up to the price of those hedges. Now, having said that, it's game on, right? Like, let's see who's lying and let's see if we can extract a little bit more premium and juice out of that stuff. Uzo did some interesting and weird stuff again this week. Again, still super headline denominated. We talked quickly about it last week with Gok. Um, so he was asking me at the time, do I still sell the puts just in case? And I was telling him, absolutely, I think you should keep selling the puts and make sure that you're hedged. Um, well, turns out this week that that was definitely a good thing to have to keep your puts. But then I maintain to what I told him last week, which is I'm not sure. So I'm giving it again an extra few days, few weeks. We never know. The the headline these days are you can't really be trusting what these guys are saying now in public, which is again pretty annoying. Normally you should be able to trust, but turns out these days you can't. It's okay, we'll deal with it. But um I'm so I was saying last week, instead of selling maybe around 20, you can probably start selling around the 10 on the put side and then start to have that slight delta negative skew into your stronghold. So nothing to do with core skew or whatever, even though there's obviously a ton of core skew in Uzo still. But it's more to have some negative deltas, I think, because obviously I can be completely wrong, but it feels like things are kind of normalizing and the price of oil isn't going to blow up much higher than that, at least not in the near term. So instead of being caught into a big move down like we had last week, and then pray again for the market to come back up, yeah, it's probably best to be there. So 20 deltas on the call side, 10 deltas on the put side. You have a little bit of negative deltas that give you a little bit of room to breathe in case you have one of those crazy headlines again that comes and say the war is over, and then until you can you can get the next headline that says that no, 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 actually the war is not over. We want to keep fighting. Um, yep, that's about it. If you guys have questions, I'm happy to answer. Oh, there's
Alex,
plenty of
so you
people
were
today.
talking about positions, as in closing positions that had been put on in the last 2 weeks, or the ones that are expiring in the next 2 weeks?
So, so actually, that's a good question because if you've put them on, let's say 2, 3 weeks ago, um, for 18, June 18, you probably, I mean, yeah, you probably suffered a little bit on Friday, but you must have sold 7,200, 7,150, 100 on the put side. So obviously that was a little bit ugly on Friday, but you're probably not sweating too much if it's the kind of position you put 2 weeks ago for something that expires at the time expiring about a month out. You're probably fine. I'm really talking about because like I know us retail traders, it's especially when the market is calm and quiet, and I know that some people aren't going to tell it openly on forums and stuff, but it's sometimes very hard to resist selling a 4DTs because the market has been so quiet and look at that data decaying. Let me just collect that stuff, right? And then you wake up Friday and you're like, oh my God, what is going on? And now I have all of that stuff on my book. What am I doing with it? So it's more to like give some sort of way out to these guys. Um, and also to, yeah, to talk about the kind of stuff we don't often talk about, because, yeah, defending position and all that stuff. I insist on this. I don't think you should defend the position. I think you should always look at what the market's giving you and assess whether or not there is a better play than sitting on your long calls these days, because right now it's really what it is, right? Like you're long the market. If you sold if you sold last week, early last week, something like 74.50, which may have been a delta 15, 20 in a 7 DTs and maybe less, but around 7 DTs. Like right now, you're basically long the market. Um, Normally, I would suspect that most people would have already uh, rolled or defend their position, however you want to call it. The only reason why it's acceptable here is because you have that. And in fact, if you really wanted to do it the proper way, you would probably close that and open it in the queues because it looks like it's more appealing in the queues these days. Um, yeah, like the probability is much stronger, 70%. Um, yeah, I mean it's pretty much the same, right? 11%, 11 point VRP, that's really high. Um, yeah, yeah, that's really high at 30 days, 12 points almost. Yeah, like but then there's SpaceX and all that stuff, so but at the same time, yeah, I would probably do that trade actually if I was caught into some weird stuff. Maybe take the opportunity to switch from selling vol in SPY to sell it in the queues because what exactly is gonna happen, I don't know. But always be careful of the. So this didn't change, right? Be careful on the call side, even if you come around here. So obviously now, like this is much neater. You have about 22 points of vol, so VRP wise, that's gonna start to look really nice again. I remember last week we definitely didn't have that at 20 delta puts, and you're gonna have some form of VRP on your call. But remember, if we take 2-3% this week because inflation's not that bad and SpaceX is taking everything off, um, you might be suffering a little bit on the call side. So yeah, just keep that in mind as well. I'm not suggesting just sell the put and sell the put only. I think you should always sell the call, but definitely don't go sell a 30 delta call. 20 delta call is probably acceptable, and same idea than the Uzo, but the other side. Maybe you want to you want to slightly add a little bit of positive delta, but honestly, I'm not sure you have to because anyway, you do 20 delta right now on the call side. That's probably gonna get you at least in SPY. It's probably gonna get you at 7,900, and 7,900 start to be really far. So I'm not even sure you need to like overthink that stuff. Because like right now it's really neat, and the reason why like it's because implied vol exploded so much that all of a sudden the range of possibilities, right, is much the, much larger, much wider. um so on the core side, yeah, 7,900, it's probably unlikely that we'll see 7,900. So you're probably still fine with a 20 delta strong goal, but get out of this stuff. My point is just get out of that stuff. Don't sit on like long stock hoping that things gonna come back. Just come here and and wait for things to settle. You're probably gonna get your money back as soon as the VIX lose 3, maybe 4 points over a couple of days, and then you have a normal VRP trade, and yeah, and it's probably gonna be easier to sit on that sort of position, because then we're getting into the end of the month. Next week's probably going to be a bit crazy with FOMC, and but then after that, end of the month, and then 4th of July, it's going to be a bit slow normally.
Does what you just said apply to stuff like SMH and EWI? Because I'm kind of caught in that because I rolled over some of the strangles that I had on.
SMH. You're caught in some short DTs here.
Yeah,
Mm,
I'm not quite sure if that's the tenor, but yes, it was. Which ones am I in?
yeah, I mean, this one is a little bit more debatable. Let's see what
I'm in the SMH, I think, for. God, I have to look it up.
I mean,
26, I think, or maybe it's the July.
oh, if you're in July, you're fine. Like, don't even dwell on it. If you're
Yeah.
in July, that's fine. That stuff is only if you're caught into the super short DTs, right? I'm talking stuff like, because that's always the game that we play. We always go into the 0 to, okay, 14 start to be acceptable in my view, but 0 to 7, it's you're asking to get punished one day. So if you're around here, and I mean
Yeah.
June
26.
26 is a bit close,
Yeah.
you could consider rolling it. Yeah, you could consider give yourself a little bit of breathing space, because
Right.
you still have probably what, 61% I just saw. It's not great, but you're probably gonna get something out of it. And EWY, what did you have? Because we finally had the move on the way back that I was hoping
EWI,
for.
I rolled it before you came out of it. Yes, on Friday. EWI, I mean the July 2nd.
Yeah, then wait. You have 28 days, give it 2 weeks and then reassess in 2 weeks. I don't think you're really caught in there. I'm really talking about those guys that were in here, three,
Oh,
4, 7 DTs, and that are now hoping that, like, oh my God, what am I doing? If you're caught into some positive delta, negative delta, and you're still above 21 DTs, you probably don't need to do much. Maybe your SMH, yeah, you might want to roll them a little bit because 26 is close. But otherwise, yeah, just give it a little bit of time.
okay. Thank you.
Yeah, Alex, I've got some ES and Qs on. Thankfully, they're July 1 and June 26 expirations. So nothing super short dated. But would it make sense to maybe staying in the same expiration but rolling it down a little, or would you just leave it as is? Because I'm either I'm getting tested, I'm short, I'm getting close to the put, or I'm at the put on those. So like in the ES strangle, I'm short the 7375 and the 7900 call. Again, in the July 1 expiration. So I was contemplating, does it make sense to just stay in that expiration and roll it down, or maybe roll like a
So
week into the future?
so here it really depends. So basically 73, 75 is pretty much at the money. So what you want, so technically speaking, it depends to what sort of risk you're trying to remove or add in your book. So normally, if you were moving it 1 week out and recentering, I don't know all the prices by heart, but the amount of Vega you have at the money is 73, 75 versus 20 delta 1 week or 2 week out. It's probably going to be very similar, because Vega is always the most concentrated at the money, and it diffuse when you go outside of the money. However, it also increase when you go further in time. So the first thing you would want to consider is, do I have more Vega by staying at the money on my put side and than what I would get 2 weeks out? I think it would probably be similar. Again, I don't know all the prices, but based on the vol surface and everything, it probably gonna be very similar. Let's see. 30 days. Let's start by looking at IV, right? It's probably going to be similar. Have a look at it, but yeah. But then the obvious trade-off is if you already have a ton of deltas in your book and you're not really comfortable with it, then in that case, yeah, you want to swap that delta risk for more Vega risk. Potentially, you might be losing actually some of the Vega, because here I don't have the answer, but maybe this Vega here is higher than that Vega here at the moment. That's probably something to consider. But yeah, the real question is, can you wait and sit on those calls, on those puts, sorry, because 26, I agree, it start to be a bit close. Maybe you can roll them out. But then I wouldn't roll just for 1 week, by the way. If you roll, I think roll at least 2 weeks out, potentially go to the next monthly contract. But yeah, the answer is, what sort of risk do you want in your book? If you're too long, yeah, just swap that delta risk for some bigger risk. And if you can wait on those, just wait. And then rolling down, I don't necessarily think that rolling down is a great idea here, because what are you swapping? You're basically swapping a lot of at the money Vega for less Vega, but also less delta. Yeah, you're basically recentering. If you really have to recenter further in time, I think it makes more sense. But not necessarily in the same expiry. And the first question, really, the true question is, okay, well, can you sit on that stuff? Some of my personal rules is, if it's at the money and if it's touched, yeah, you have enough justification to say you take it and then you push it 2 weeks out, and then you sit on it. Yeah, that's what you can consider.
Okay, thank you.
You're welcome. All right then. Thanks, guys. Thanks for showing up, and I see you on the Discord tomorrow. See you all.
Thanks, Alex.
Thank you.
Thanks.
Thanks, Lauren.
Bye.